Good afternoon. This is David Ruffin, Principal of IntelliCredit. There are a number of people that are signing on. We will begin the presentation in about a minute. Well, good afternoon again. My name is David Ruffin, Principal of IntelliCredit. Welcome to the Loan Review Best Practices Trends webinar for today. Frankly, we thought, given the time of the year, it might be pertinent to talk about some best practices in loan review, because traditionally, it's been my experience that this is the time for budgeting reasons and other RFPs that may be going out in terms of securing loan review expertise for financial institutions. And so therefore, we'd like to share today specifically some best practices. Again, IntelliCredit, if you don't know, is the newest division of the Quick Rate family of products and services, which has been around a number of years. IntelliCredit was just formed in 2019, but in the broad tradition of Quick Rate, we are very dedicated to providing community financial institutions affordable and practical products and services that we think fit the community financial institutions. Today, I am joined with Larry Poole, our director at IntelliCredit, and David Littleton, our manager. Particularly, Larry and I have a number of years in banking, as you can see. We have experienced thousands, literally, of loan reviews and hundreds of due diligences where portfolio reviews have taken place. We have done work for commercial banks, credit unions. We've done work for private investors, looking at marks on loan portfolios. So we have some experience in that regard, and so hopefully it gives us a little bit of credibility, we'd like to think, in terms of sharing some best practices with the audience today. So from our perspective, I've been around in the industry a good while, and I do recall in 1990 when, particularly as a result of the RTC crisis, it was mandated that independent loan review be ascribed to all commercial purpose loans. And that's been made loan review in effect almost a commodity in the marketplace, or almost a utility perception or presumption that it needs to be done one way or the other. We have seen some approaches that work and don't work. Larry and I have been in the production and risk firing line, so to speak. We've been on both sides of the so-called risk production divide. To us, credit is not academic, and that's hopefully part of the things that we can share with you today in terms of practical best practices around the loan review. One of the concepts I think is quite important, and that is the understanding of how important quantitative versus qualitative components of frankly, understanding credit generally, not just in loan review. But frankly, there are some aspects of loan review that lend itself to a lot of fixation, if you will, on the quantitative or the mechanics of credit. I tend to believe, over my many years of being in the credit world, that a lending decision or a credit decision is often the capstone of a big pyramid. The pyramid is largely populated with a lot of quantitative metrics and ratios and exercise, but almost all loan decisions in the end come down to a fairly qualitative decision. And I do think it's quite important that your loan review expertise or vendors have that capability to match and balance both quantitative and qualitative. We are certainly, in effect, a symbiotic relationship with regulators, and knowing what they see is important. Frankly, loan review is a key part of what they use. in their examination work of all financial institutions. And we use this term quite a bit in our shop, and that is allowing a bank, but what the bank should be focused on is writing your own script, because it's by nature the regulatory world. They kind of come in to your organization with a bit of a proxy on what they think your risk profile may look like. But I think it's very incumbent on you to kind of take that bull by the horns and be sure you are in control of writing, writing your own script. This is a concept that we spend a lot of time with in our own group, and that is we and loan review generally doesn't have corporate authority. It certainly doesn't have regulatory authority. The real power that effective loan review has is that of persuasion. And a lot of that may come with things like good bedside manners, diplomacy, sticking with the facts, the capability, frankly, of discussing tough situations in a professional way, in such a way that may persuade people that maybe another way to look at this credit risk or emerging credit risk is important. So I think all of those things are quite important for loan review. But we're looking at a business model that is relatively unchanged in decades. I mean, particularly third-party outsourced loan review, other than maybe spreadsheets and word processing, it is really an unchanged model. And one of the things we have said about it in IntelliCredit is to frankly change that in and of itself and offer a different perspective to loan review. We are today going to ask the audience 3 polling questions to keep some participation going here. And of course, you will be, this deck will be shared with all participants. So what I'm going to do now is go to the first polling question, and hopefully you all can see that. And if you can answer the question of, do you see your loan review as more of an audit or an advisory service? And we'll give it a few more seconds. And so I will share the results of the poll, and it looks like it's pretty evenly split. 56% consider it an audit, 44% consider it an advisory service. I'm known for sharing some opinions, and so I think at this point I will admit my bias is clearly that it's an advisory service. I think so often people think of it as an audit it's going back somewhat to that kind of quantitative qualitative divide, but that's just kind of my bias. But it's very interesting that the audience today is split fairly evenly. I don't think any of this discussion is ever very informative if you try to treat it in the theoretical sense, if you don't understand the context in which we meet today, and that is really a dichotomy of what anybody ever dreamed we would be at the beginning of COVID. 2020 was arguably an extremely high performance community banking year, financial institution year. The banking Armageddon that was feared by everybody just did not materialize on the financial industry. Credit metrics at 10,000 feet imply absolutely nothing onerous has occurred. There are a lot of temptations to claim victory in our industry. We're just that good at managing our institutions through the teeth of a horrible pandemic or a worldwide crisis. We've certainly got more capital. The banks, and this relates to the banks, of course, more capital than we did a dozen years ago in the last financial crisis. And there's not one iota of criticism that can be pointed to the financial industry, as happened in the last crisis, that we had anything to do with or blame for the problems that sent us to the Great Recession a decade or 12 years ago. I've shared this with a number of groups, and there's a deceased commentator named Paul Harvey who used to do kind of his homily every day on radio and television, and then he would almost always pivot midstream to say, and the other side of the story. And I think if we're going to be intellectually honest within our industry, which I think is very important, is that we've got to accept the fact that what I call government largesse through the PPP program and then the regulatory respite that was afforded our financial industry has clearly contributed to the healthy financial metrics we look at, and even the credit metrics we look at. And some could argue that that is somewhat artificial because, again, of the government largesse and the regulatory respite. One of the things that we're having to deal with, and we've seen this at least so far in second quarter call report from the commercial banking side, is that we're in negative loan growth. And that is a huge issue for the banking and financial industry as a whole in terms of where we go and look for that growth. I don't mean to be trite here, but I think there's a little bit of a taint of traditional debt. I've said to several people, you've got a market psychology issue at work here. If you've been a year being able to borrow money that you didn't have to repay through PPP, it's going to take a little bit of an adjustment to start thinking about, oh my gosh, I've got to repay this loan. That sounds a little, trite again, but there is some truth, I think, to some degree of market psychology. I tell this to our clients all the time. Remember, our clients and prospects reside on Main Street, not Wall Street. We just can't be consumed by what obviously was an incredible comeback from the spring of last year with the advent of COVID, because Main Street is largely ferreting out the winners and losers still in this COVID or post-COVID world. I'm asked from time to time, and I think this has a lot to do with loan review, is what is the most impactful aspect or factor impacting credit quality in our portfolios? And I've come to believe that it is truly the market value of the commodity, and that's a loose definition of the word commodity in the most liberal sense, which would include all products, goods, and services produced by our borrowers, is, in my opinion, the single most impactful factor in determining credit quality in our portfolios. It has huge impact on supply and demand, the revenue, the margins, the repayment capacity, and yes, the collateral value in the end. There are many uncertainties going on, and there's a lot of changes afoot in lending. The PPP program, of course, has ended. A lot of institutions are trying to figure out how to convert some of the PPP money or clientele over into more stable organic loan growth. I can't imagine at this point any financial institution not embracing and more aggressively the government guarantee programs that are out there now, and for three reasons. One, it certainly provides an opportunity for growth in this so-called negative loan growth environment. Number two, it gives good fee income. And number three, as important from a risk perspective, it perhaps gives you that mitigant of a Band-Aid to say, well, yes, this particular borrower would not have met our normal credit standards, but with the addition of a government guarantee, we feel like we can proceed on with the transaction. In the broadest sense, I think the economy is in the midst of the greatest churn since the internet revolution itself. I think, again, not just ferreting out winners and losers from the COVID world, but I think you can look at an array of areas. The e-commerce, digital shopping was already having a major effect on big box retail well before COVID. COVID has exacerbated that. COVID arguably may have changed the paradigm of office space forever. And we know the story there. There's also, and this goes to the issue of lending opportunities and the negative loan growth we have become so skeptical and afraid, frankly, in the financial industry of speculative lending that as a result of the abuses of the last crisis, is that we've got certain markets. I'm speaking to you today from Raleigh, North Carolina, which is a market that really has no inventory of houses in a certain strata. In other words, it's got an artificially inflationary valuation of the housing market, and somewhat because banking and lenders have been afraid of getting out anywhere in terms of a speculative lending. Again, no one's arguing for the abuses of a decade ago, but certainly in certain dynamic, vibrant markets, there should be some mechanism where we can, as an industry, start lending into legitimate needs to put more balance in the supply and demand. I put small colleges and universities on this list as a sensitivity concern because, one, they've been hit by double whammy. They've clearly, it's a lot of community financial institutions have diversified. Our loan review work shows that over the last 10 years. And COVID certainly has affected the college experience significantly. But even prior to that, perhaps unwittingly, as a result of the 2017 Tax Reform Act, which effectively de-incentivized charitable giving. Barron's has objectively estimated $68 billion less in charitable donations were made in tax year 2018, which was arguably a very robust economic year. Point being is top line revenue at all nonprofits is really charitable giving in many ways, incentivized by the tax code. Obviously, restaurants and hospitality come to mind, particularly due to COVID. I give our good client, customer, CEO, Kevin Fahrenkopf, the Bank of Hemet, credit for this interesting term. I was on a panel with him with California community lenders about a month ago, and he used the term, he said, well, we now ask our lenders, is it Amazonable? And his point being, if the service or product can be obtained by the internet or through something the likes of Amazon, we have to realize that that may have changed the dynamic around where our particular customer prospect. For an example, he said 5 years ago, we wouldn't have even thought of aggressively looking at nail salons or tattoo parlors, but they're not Amazonable because that service doesn't lend itself to these things. That, I think, just depicts the churn that we're all going through to try to figure out where legitimate lending opportunities are going to be. Again, that's part of the landscape we all face. I would like to share, and arguably these are community numbers, but they're community bank numbers. In terms of the basic credit metrics, and they're all effectively showing an incredibly benign circumstance. The chart to the left is the inventory of problem loans in the commercial banking system under $10 billion institutions. As you can see, if anything, they continue to kind of decline from COVID. Again, nothing showing that COVID is having much effect. There's some regional differences. As you can see, the Southwest seems to lead a little bit of the other regions in terms of the of acknowledged problems. Net charge-offs are non-event at this point and have been, frankly, for some quarters. ALLL, or the reserves to your loans, again, they're averaging out there anywhere regionally at a high of 156 to 118. But again, we haven't seen quite the spikes that we saw in some of the mega banks where they have released significant amount of reserves of late since the so-called COVID crisis has passed in terms of feared credit quality. An inverse of that, of course, is how much of your problem loans are being covered by your reserves. And as you can see, in addition to the capital in the banking industry, look at what the reserves they're covering, in many cases 2.5 to 3 times the acknowledged inventory of problems. So where does loan review fit in the current environment? I think almost no one, frankly, any astute financial expert running a community financial institution that I've spoken to, almost no one believes that the current benign credit metrics will last forever. The post-government stimulus, of course, has to end at some point. And the post-regulatory respite of 2020 has already ended. There's, as I said several times, regulators are kind of back in the saddle. And I think robust loan reviews will reduce the uncertainties from the COVID effects. There's an old adage that says credit tails always have a little longer duration than the economic shock that created them. We haven't seen the credit tail yet, but traditionally it has a longer period of time to affect itself. I do think it's an empirically proven thing that early detection of emerging credit risk help in 2 key factors. They reduce losses, and it also provides, frankly, more latitude to move credits out if they're movable. I do think it also provides and this is really where we may be getting into a lot of pressure at financial institutions to start booking loans. And those of us who've been around a long time understand what the byproduct of that could in fact be, which is looser standards. And if we have economic headwinds that hit in a year or two, some of those looser standard credits that were booked become the most toxic and most problematic. I think a good loan review would help get a so-called quick read on what's being booked in an attempt, frankly, to stem this issue of negative loan growth. And again, I think a good effective loan review does aid in your writing your own credit risk profile script before a regulator writes it for you. So let's talk a little bit about best practices in general. We think certainly credit reviewers with deep credit experience need to be as a part of your loan review team, not just junior CPAs. And why that's important, again, that qualitative, quantitative aspect, the experiential component of having been there, done that, so to speak, is really, I think, where you get a better product and a better deliverable. We advise our clients, whether they use us or not, frankly, to make sure you get bios of people that are doing review work in your bank, because that may tell you the skill sets and the level. And again, when we're in totally benign environment, it may not make as much difference, but when we get any degree of stress rearing its head, it's going to be quite important that you have seasoned credit experienced people doing loan review. We are big advocates of looking at documentation and review with paralegal talent to be done separate from credit review. There are different dimensions of the lending process, and I think talent should be directed accordingly, or different talent should be. I think particularly in this environment, you need to be looking for smart, informed sampling, not just randomness, and certainly not just something that would make you feel better. But I do think just an ability to look at very, very informed sampling that would show, again, emerging risk. I think it's very important that you segregate and differentiate documentation, credit, and policy exceptions because they all have different characteristics, but they do need to be quantified. I do think even in the terms of, we think it's best practice to look at a kind of a pre and cleared exception metric. Why is that important? In the best of times, what we're seeing is that a lot of loan reviews show bottom line, almost no degradation in bottom line credit, but the degree of exceptions, technical or credit, may be so significant that it really speaks to the quality of the loan credit process itself. And I think bank management and bank boards and credit union boards and credit union management should be aware of it. Again, it doesn't necessarily mean that's an indictment of the credit quality. It's just the credit process may be needing to be tweaked. Certainly, we think that, and this is, of course, came under the new guidance in 2020, there's no longer the real option of financial institutions to tell a loan review company or vendor to say, don't look at the substandard, don't look at the workout loans. We've already had enough energy on those. We know the problems there. It's now expected that that you do look at those. Certainly, we also believe in differentiating our ratings, or a rating of an original underwriting versus how the loan is being looked at or post-service after booking is important. Differentiating perspectives on pricing for risk. In other words, is there any illogic in the way you've risk graded? The higher the risk grade numerically should also come with it a higher return for the risk you're taking. And collateral valuations, loan vintages, as I alluded to a moment ago, it's been empirically proven that when loans are originated and how they move as a group have their own characteristics in terms of risk, particularly when we are faced with some economic or credit stress. We believe too that particularly community financial institutions under Dodd-Frank were really not required to do any kind of stress test. But everything we're hearing from regulators of late is that they're going into bank after bank and credit union, particularly with higher commercial involvement, to be sure that you're doing some version of a stress test to make sure that you know where the risks are embedded in those areas. We think that, and we'll get into this in a moment with a little more detail, we think companioning that with a loan review is actually an excellent idea and an efficient way to kind of kill two birds with one stone. We think now that, making a much more transparent and less intrusive to management ability to understand what's going on from a real-time reporting and exception clearing. Larry's going to speak in a lot more detail to that in a moment. And one other little tidbit that we find vexing a lot to financial institutions, and that is sometimes they bring in loan reviewers that have their own biases around a risk grade definition. Any loan review, third-party loan review, is tasked with interpreting your risk grade guidelines around the past. The non-pass loans, criticized classifieds, the definitions of those are largely set in a national, largely by the regulators from a national perspective. But your risk grade, your individual risk grades are idiosyncratic to your bank, and that should be the touchstone by which a loan reviewer interprets the past category risk grades. Again, I misspoke a moment ago. The workout plans have been added to the interagency guidance that is now expected under normal loan review procedures. We do think that good loan review practice would include comprehensive management and an appropriate high-level abbreviated form of that to get to boards so that boards aren't swamped with a lot of interesting but not as important detail, and that you accompany that with some degree of public or peer data comparison to how you're performing. I hope you've kind of picked this up already. I just feel like very strongly that part of good loan review is that it's collaborative and consultative. That's kind of why I have the bias of loan review ought to be seen as an advisory service, not necessarily an audit. And I do think that's critically important to the ultimate success of a good loan review, is the ability to both sides to sit down on certain circumstances where there may be a difference of opinion and just hear the other side out in a healthy dialogue. And in the end, and particularly in the environment we live in today, best practices should absolutely include using, to the extent you possibly can, technology to automate everything you can. That is absolutely critically important. That is not in any way to imply, however, that you should sacrifice quality and substance for some kind of superficiality. But I think the efficiency and the transparency, which Larry will mention in a moment, is really important to utilize and leverage as much as you can technology. So at this point, and that is a good segue to Larry, if you would like to tell us where you think automation kind of brings that benefit to best practices in loan review, Larry.
Yeah, thank you, David. And thanks everyone for your time today. Just wanted to take a couple moments. David just ended speaking through some of the loan review best practices. This is probably the one slide in the deck where I wanted to tell you a little bit about our process as IntelliCredit when we perform third-party loan reviews. As David said, we know this is budget planning season, and we'd love the opportunity to put an RFP together for you. But one of the things that we're doing that sets us apart, David already mentioned, we have some very seasoned credit professionals that are doing our reviews for us. But in IntelliCredit, we've taken automation of this process and just made the logistics a whole lot easier. So one of the things about our loan review, we house everything in a web-based portal. Your team, as many team members as needed, are given access. One of the biggest things that sets us apart, I believe, is our desire and our ability to use data, and I'll show you this in a moment, but our desire and ability to use data to inform smart sampling. So everyone at the bank, everyone at your credit union, loaner vendors know that past due credits and non-pass credits, those inherently have more risk. That's a given. But how do we use data to smartly identify, even on the front end, specific loans and specific credits that we should add to the sample? As I mentioned, we use a web-based solution, and that's provides several benefits. One, it really just greatly reduces the number of meetings and allows us to share data in a more communicative and collaborative effort. All of our reports and all of our exceptions are published to this portal in real time. So as we do work throughout the day, you're not waiting for us to give you a list of exceptions or a list of loan review reports that we've completed. Those are done in real time and will be easily accessible to you within this web-based portal. So again, a little bit of plug of IntelliCredit, but our process, in addition to having those seasoned credit experts through our online application, we've just solved a lot of the logistics of the loan review as a service, which we'd like to show to you. David, if we can go to the next slide. One of the things that we recognize as loan review firms is we already hit on this a little bit. We really need to move from a pure random sampling of loans to a more informed risk-based selection process. So traditionally in loan review, we would get your financial institution's core system file, and most loan review vendors just pick a couple non-pass loans. They pick the largest loan and maybe a random sampling of loans, and they hope that they uncover new things within those credits. What we want to encourage you to do is you're talking with loan review vendors, make sure they understand your portfolio and help you identify your hot spots even on the front end. So one of the things that we always like to do is try to ask the question, and this is before we even start the loan review process, before we even selecting a sample, is how do you compare to your peers? So this chart in the top left, we try to identify some red flags. What this is showing for all banks and all credit unions, we actually look at your portfolio based on public data and kind of rank you based with your peers. So things that you see in the red means that you're probably performing a little bit worse than your peers, and things that you see in the blue and green means you're performing a little bit better than your peers. So if I'm one of the first things that I'm going to do if I'm looking at this bank or this credit union is I'm going to say they have higher concentrations of commercial real estate loans and construction and development loans than their peers. So I already know from those two metrics that I'm probably going to want to focus on those areas when I'm selecting a sample. As David alluded to earlier too, your portfolio should reflect the risk within its pricing. So we would expect to see as the risk grade decreases. So with lower risk grade, you should have higher pricing. One of the things that we always look to when we select the sample is that true? So in this chart in the bottom right, you can see that loans that are secured by farmland, those that are 1B, and agriculture and production loans, there doesn't seem to be any logic. For instance, in the agriculture and production loans, the weighted average interest rate for those credits in risk grade 2 is the interest rate of 6.75%, whereas the weighted average interest rate for risk grade 3 is less than 6%. So something doesn't add up there. I know within my sample that I'm going to want to pick some agricultural production loans to add to the sample. So just ask those questions to potential loan review vendors. Can you help us identify some risk maybe within our past credits even up front before we select a sample, because that's going to help you help them better inform some observations throughout the course of the loan review. If we could go through to the next slide, another thing that you should ask with potential loan review vendors is they should understand and help you understand your financial institution's concentrations. So one of the things that we always want to do is we want to look at, and we typically do this by your FFIEC codes or your call report codes. We want to see if we can identify any concentrations within risk-based capital or any concentrations based on your risk grade capital. So for instance, we're actually in the middle, one of our teams is in the middle of a loan review right now in Ohio. When we began the sample selection process for the loan review, we noticed that they'd had tremendous growth over the last 2 years in both agricultural and production loans and in loans secured by farmland. It was very obvious from looking at public data. And we inquired of the bank, is this strategic? And they said yes. But what that tells me as a loan review vendor is I want to look at some of those larger, newly originated ag production loans and real estate secured farmland loans, because those loans are going to have risk ratings. You don't make loans or originate loans that are non-pass, but we want to make sure that the fundamentals of those loans not only pass muster, but how is the bank done at underwriting these credits? How is the credit union done at underwriting these credits? It's easy to make a loan, but are the fundamentals of that loan reflected within the risk grade within the bank's underwriting? If we could go to the next slide. Another thing when you're speaking with potential loan review vendors They should understand and help you understand the subsets within your portfolio, specifically loans that have been affected by COVID. We try to, and I want to even take this a step further. One of the things that we want to do and would encourage you to do as management teams is to really drill down and see if you can, by industry, are there any risk pockets within your portfolio? So in these charts right here, we always look at portfolio subsets by NAICS industry codes. We know that service industries, as David alluded to, nonprofits, those have been impacted harder by COVID. But as he said, we aren't even seeing a lot of deterioration in credit quality yet, because let's take a church, for example, that has maybe has a real estate loan. They've had as much as a 6 to 9 month deferment from COVID. Maybe they got some PPP money. That church could have tremendous decline in giving, and it hasn't hit the books yet. So you want to see, like, for your service-based industries, your restaurants, your hotels, your motels, you really want to make sure that you, as a management team, and your loan review vendor has a grasp on those loans to select, and specifically those loans that have had historical COVID deferrals. If we can go to the next slide, one of the things that I like, and this is straight from our software, we like to try to take two essentially core system files or two flat files and just compare those and see, do we see any risk profiles, not just overall, but within the data that need further that need a little bit of further explanation or further exploration. So make sure that your loan review vendor recognizes that even within the same portfolio, there may be various risk profiles across the different loan types and product types. So on this graph to the left, what you're seeing is we essentially took two core system files, one at one quarter in and one at the following quarter in, and we made a bell curve, and we said, has there been any migration within that bell curve from between the risk grades? And the answer was really no. If you look at those two bell curves from quarter in to quarter in, not much has changed. But then for the same bank, the picture on the right, we took that a step further and said, not just the portfolio as a whole, but what about residential construction loans and different? Is there been any divergence in risk rating? And there the answer is yes. For this portfolio, and it's hard to see here, but from one quarter to the next, a significant number of their loans were downgraded from a risk grade 3 to a risk grade 4. Both of those are past risk ratings, but that divergence let us know as a loan review vendor, we want to select risk grade 4 residential construction loans to see, why did somebody at the bank over the last quarter choose to downgrade those credits. One of the biggest things that David already said, the biggest takeaway from this whole presentation, if we as management teams and as loan review vendors can help you identify risk grade migration within the past categories, it's a whole lot easier to get in front of problems if a loan is still rated pass than it is when a loan moves to special mention or substandard. So the next slide, again, this is straight from our software. One of the things that we're doing is we ingest a bank or credit union's core system file, and we can do some smart sampling. Here's just a quick example where I've built a query based on 3 characteristics. I said return all hotel loans that have had COVID modifications and that have had at least one 30-day past due delinquency. So those 3 characteristics, if I go to the next slide, for this bank, it identified 5 loans. You can see that these 5 loans all had COVID modifications. All of them were risk rated 4, so that's a pass rating. Something else that I found interesting for these credits, all 5 of these loans were 16 days past due. So not only are these hotel loans that are pass rated, that have had COVID modifications, but they're showing some stress. They hadn't hit that 30-day mark yet, but this is the type of thing through our smart sampling that we can identify. This group of loans is not going to pop up on a management report. It's not a non-pass relationship. It's not 30 days past due, but here's a clear example of where just through the smart sampling, this would be a perfect relationship is $3 million in balances that has some historical delinquencies that we would 100% include within our loan review sample. If you could go to the next slide, David, kind of wrapping it up. One of the things that we talked about again was our technology and our portal. I just wanted to show that to you really quickly. What you're looking at right here is just a snapshot of our exceptions portal. So we track 3 types of exceptions: legal doc exceptions, credit exceptions. Those would be things such as missing financials, and then loan policy exceptions. When we're doing the loan review, as soon as we cite an exception, it appears within this portal. Your team has access to the portal and you can clear it from this portal. So in this top table, these 3 line items that you see, these are 3 outstanding exceptions. And what I've got circled over to the right is just the ability for the bank or the credit union to upload a file to clear the exception, and then even leave us comments and feedback. Because it's all encapsulated within this portal, it's just a very easy to use and easy process. Once your management team or loan ops team or loan officers uploads data to clear exceptions, we clear them from this portal, and that's what you see in the table below. We've bifurcated, as David said. Not only do we track a list of outstanding exceptions, but we track a list of those that have been cleared as well. It really speaks to what is your origination and loan closing process. And then finally, the last slide before I turn it back over to David, this is an example of our real-time reporting portal. So again, as we finish work and publish reports, your management team or anyone else at your financial institution who should have access will be able to go in and see our work in progress. They'll be able to see work that has been completed. What you're looking right now is a summary grid of the loans that we've reviewed, but each of these credits under that borrower name column, within the portal, you can click on the borrower name and actually pull up the full individual loan write-up for that credit. So again, a little bit of a plug for IntelliCredit here, but our exceptions and our reporting are captured in this portal, which just makes logistics and the process much less intrusive for your financial institution. Again, a key takeaway, if I could say anything for my portion of the review or portion of the demo, when you're speaking with potential vendors, really ask that question. Can you help us identify potential risk product or risk pockets within the pass rated credit categories that we want to review as part of our loan review process, because that's where you're going to get your most bang for your buck. Thanks for your time. I'm going to turn it back over to David, who's going to talk a little bit about the recent interagency guidance.
Yeah, thank you, Larry. And I would just say again that, everyone likes a good, no one likes to go to the doctor and get a physical that has some problems in the report, the blood work or what have you. Everyone likes a clean report. But from a credit risk perspective, the reality of it is absolutely there is a correlation between early detection of risk and the ability to stem losses. And you almost have to make sure that has more importance to you than a temporary good report, if you know what I'm saying, because there are all sorts of ways that you can turn even a loan review report that has some issues embedded in it into a positive with regulators by saying this is part of our team's effort to look at our credit, and we're taking steps to remediate those concerns that came up through there. So my point there is don't be afraid as credit stress rears its head to tackle it head on. The interagencies, and that includes the NCUA, the FDIC, the OCC, and the Fed, all got together in 18 and 19, frankly, probably thinking we've been in such a long period of benign credit quality that it's inevitable that we would end up having a turn of the cycle. No one at the time, of course, envisioned COVID. And we've talked a lot already about what COVID perhaps artificially is showing at this point. But this was issued in its final form on May 8th of 2020. And it does basically, it's basically commonsensical, and it's a restate of basically standard principles that regulators would expect a credit risk review system, with the addition of a couple of things, as we alluded to, about reviewing workout plans and so forth. So regulatory expectations, I don't think there's any question. We're hearing it anecdotally. is that the regulators are back in the saddle as we hear. And what they are generally expecting is a significant amount of proactive steps being taken by the financial institutions that they supervise to quantify and depict potential COVID effects in your portfolio, including, robust and informative stress test, portfolio analytics, and loan review. And those on their face of it sound like kind of strange bedfellows. And at this point, I'd like to ask the second polling question, if I may. Let's get to that polling question 2. And if you would respond to these questions. Does your loan review relate directly to portfolio analytics or to stress test? Either they do in both categories or neither. I'll give it about another few seconds. We're going to end the poll now, and I will share the results. And an interesting group, 30% say it does include portfolio analytics. I'd be interested, as the last polling question does try to differentiate between internal loan review and external loan review, but no one is tied to stress testing, which is interesting. And in some cases, there are both, and in many cases, they're neither. So it's quite a spread of experience. So let's stop sharing that, and let me go into the what I think is the future of credit management input. That's going to take a while, particularly for community financial institutions. Some of the bigger financial institutions are perfecting some of this, and that is the syncing of these 3 critical management inputs. Currently, though, at the community financial institution space, they're generally provided at different times by different methodologies with different vendors, often different points in time, and certainly are not complementary or coordinated, which I think, while it may meet a checklist to regulators or investors, it certainly doesn't necessarily give management as much clarity as it needs to in that sense. We feel like that this is the future of bank management and credit union management in terms of credit risk in the future, and that is merging more, syncing more stress testing, loan review, and portfolio analytics, making them far more coordinated and in sync with each other. How does this make loan review better? Well, all of that informed makes for smarter samples, as Larry walked us through, and particularly if you got ties to portfolio analytics to do that. And I do think stress testing companioned with loan review is really a real interesting concept, particularly for community financial institutions. Remember, the great thing we've got going for us in the community space is stress test is not prescribed in any way. It's not like DFAST or CCAR, where it's very rigidly prescribed as to what a stress test must be. It's really in the eye of the beholder. While we think this is an efficient and effective way to kind of say, yes, we've done a stress test, is companion it with loan review, because it does kill 2 birds with 1 stone, has a lot of the efficiencies built into leveraging on that kind of loan by loan, if you will, tedious file by file engagement that comes with most loan review engagements. It's also the most real-time, I would argue, perspective of a borrower's current circumstance. It kind of offsets that relying on potential out-of-data or initial credit underwriting data, which now may well be stale. I think that is the benefit and the beauty of a loan review perspective. It is arguably the most current perspective of what a borrower credit status is. And I do think it could be done in such a way that plays on the various sensitivity analyses that are often applied, projections, if you will, to underwriting. I remember speaking to a board member many years ago who was very adamant to me about why on earth would we spend money on a stress test? We're not required to do it by a regulator. And the only comeback I could muster to him was, well, don't you do projections on particularly your C&I prospects in your loan portfolio? And he said, yeah, I think that's standard protocol. I said, well, why wouldn't you apply that to your own bank? That's really what a stress test is. It's a projection. It's an attempt to put establish and acknowledge some guardrails by which you can incur either risk or loss and still not get into trouble from a capital perspective, or even, for that matter, an earnings perspective. And I do think the fact that you could combine a stress test information with the traditional summary charts that come with most loan review vendors and their presentations would, again, just add to a much more interesting dimension and informative dimension to both management and board, and frankly to the regulators, because we are hearing without any question that in some cases, particularly banks with significant concentrations, where regulators are strongly suggesting, quote, the next time we're here, we'd like to see some form of credible stress test done at least on a segment of your portfolio. How would we envision that? That's one thing to say it in concept. How we would envision it would be to begin to take inventory of the data that you might have available in a more automated way, and certainly determine how current it is or accurate it is. Again, as Larry said, leverage the kind of analytics around where your concentrations, vintages, subsets, hotspots may be. Then start to stratify, identify those segments that might have more impact on your portfolio, which would become your sample. And the goal here is to, in concurrent or contemporaneous to a loan review, you would have a subset of loans that you would be stressing. And then that could be extrapolated to the, say, the entire CRE portfolio, say, or certain other portfolios that might be of interest in a stress test. And you, as you see here, you could devise a number of scenarios. The most simple would be the last bullet point, using standard underwriting metrics such as loan to values or debt service coverages for CRE loans. Even the FDIC depicted this as a relatively non-complex, acceptable way for community financial institutions to perform stress. The chart to the left shows a pre-stress in terms of loans at a certain debt service coverage and loan to value as its impact on risk-based capital. The chart to the right shows a post-stress where you just extrapolate, you put some stress on, you put a factor of increasing the loan to value and decreasing the debt service coverage, showing you what does that do to that portfolio in terms of its exposure to your risk-based capital. We're big advocates of using a combination of top-down and loan level, but this certainly would be a very legitimate, credible way to get a loan level stress test done for particularly a subset or a part of your portfolio that you might anticipate a regulator having a little more concern about. Again, stress testing doesn't mean it's going to happen. It just gives you the ability to understand where you would be if it did happen. Final poll question is this, and is your loan review, let me get the third polling question, and up there, is your loan review done by an internal group, an external vendor, or a hybrid of both? Good. Well, this was a little bit surprising. There's a lot of people in here with internal loan review that is their primary, let me share the results here, that is their primary go-to. That is an interesting result, because oftentimes internal loan review is thought of as more of a larger financial institution process. So that is frankly a little bit surprising to me. But therein lies also an opportunity to share with you kind of where we are with IntelliCredit. This is, in our opinion, kind of the traditional loan review process, highly intrusive, a lot of blind data flying back and forth, very much downtime associated with managing that engagement from an internal standpoint, internal management standpoint. We at IntelliCredit have done everything we can to automate, make more transparent, make more real-time, make less need for standard meetings except through collaborative purposes. In other words, done that through tremendous transparency and visibility to see what is going on. And tremendous feedback we're getting is that this really does help. It helps on our end, frankly. It makes the process more efficient, but it also is a huge benefit to your staff. Why that's important particularly given the poll results that just came up, that frankly surprised me a little bit. We have designed our platform not only for our own purposes to do third-party loan review, but we are getting a lot of traction on internal bank loan review staffs that are also looking to make their processes more efficient and more effective. We would love to do have some discussions with you. I think it would be important to embrace these kind of sea changes that are, I think, going on in loan review. We think we can provide great quality, good pricing. The pricing to us is one, we're parked in a family of products and services that's historically where the tradition is for quick rate, and that is we provide community financial institutions with affordable and practical solutions. And I do think it's an alternative to just another intrusive audit experience. One of our satisfied clients, chief credit officer, says, with our loan review, I do get my day job done and still get the first class deliverables, which was a very kind compliment. And lest you think it's just about us feeling good about what we've put together, the market is beginning to accept this. Nominally a competitor, ProBank Austin, who does loan review on their own for service, has adopted the program. A larger accounting firm in the Southeast, Warren Averett, has. Of course, we've been listed by ICBA as a preferred service provider. So I hope you would see that as validation of the marketplace, that this use of technology, use of automation, combined, frankly, with never giving up the standards that we talked about early on in the presentation, which are best practices. I would never give up any of these in terms of what I feel like needs to be embedded in your loan review deliverable. The great thing is if you can match those and do that in the context of a much more efficient program, automation or technology, leveraging technology more. So again, and also it meets the standards of every aspect of the new interagency guidance, again, from all the regulators, credit union and commercial banks. Next steps in conclusion, please evaluate what you've got. We do know this is kind of season for sending out RFPs for loan review for next year or future years. We would, in all due respect, love to be able to find a way to have a dialogue with you and be included at least in that list. We absolutely commit to meet or beat the cost of your last loan review, assuming the scope would be similar. Why? Because the efficiency. The efficiency, frankly, from a business perspective, gives us better margins on our end to perform it. And so it's not just a matter of efficiencies that you benefit from. And in that sense, that's why we are so comfortable saying that we could cap your cost relative to any risk of a future increase in cost for loan review. Again, and you'll receive, even if you do loan review as a service, you'll receive significant amount of the opportunity to utilize these tools for an extended period of time. Reminder, we do provide loan review as a service. We also have cloud-based technology that is housed by Amazon Web Services. It's SOC compliant. There's no software integration. We do the heavy lifting of mapping your financial institutions' idiosyncratic loan files, and then subsequent information is pretty push button. We really do appreciate you attending today. We hope that we have given you some sense that whether you look to IntelliCredit or not, that these are some attributes that you can frankly hold to standards to other vendors and also internally in terms of what really makes loan review more effective. Again, thank you so much for attending. Please reach out to me personally if we can be of any assistance or continue any kind of dialogue around a potential loan review engagement proposal. Thank you so much.